Welcome to our deep dive into free cash flow, or FCF, a metric absolutely critical for understanding the true financial health and potential of any business. In the world of finance, while profit often grabs headlines, it's cash that truly tells the story of sustainability and growth. FCF represents the cash a company generates after accounting for cash operating expenses and capital expenditures. It's the money left over that's truly free for the business to pursue opportunities, reduce debt, or return to shareholders. For investors, FCF is the ultimate indicator of a company's ability to generate real wealth and drive sustainable value over the long term. Understanding FCF isn't just about crunching numbers. It's about gaining a strategic edge in assessing a business's capacity for independence and expansion. So, how do we arrive at this crucial figure? Deconstructing FCF involves a few key steps. We start with a company's operating cash flow, which is the cash generated from its normal business operations before any capital investments. From this, we subtract capital expenditures, often abbreviated as Capex. These are the funds a company spends to acquire, upgrade, and maintain physical assets, such as property, plants, industrial buildings, or equipment. These investments are essential for a company to continue operating and growing. Additionally, we make adjustments for changes in working capital, which includes short-term assets and liabilities, like inventory, accounts receivable, and accounts payable. Managing working capital efficiently directly impacts the cash available. By taking these components into account, we pinpoint the actual cash flow available to a company after funding its core operations and necessary asset maintenance. Many often confuse free cash flow with net income, but they tell very different stories. Net income, while important, represents a company's accounting profit, calculated using accrual accounting principles. This means it includes non-cash expenses like depreciation and amortization and recognizes revenue and expenses when they are incurred, not necessarily when cash changes hands. FCF, on the other hand, is about actual cash. It reflects the cash generated by the business after all operating expenses and crucial capital investments are paid. This distinction is vital because a company can show high net income on paper but struggle with cash flow, potentially facing liquidity issues. FCF provides a much truer, more transparent picture of a company's ability to generate tangible wealth, pay its debts, and reward its shareholders, making it a superior metric for assessing financial health. Let's get practical and look at how free cash flow is calculated. There are primarily two common methods. The first and most straightforward approach starts directly from the cash flow from operations found on a company's cash flow statement. From this figure, you simply subtract capital expenditures. For instance, if a company has operating cash flow of $10 million and spends $3 million on capital expenditures, its free cash flow would be $7 million. A second method, often used when starting from the income statement, begins with net income. To this, you add back non-cash expenses like depreciation and amortization, then account for changes in working capital, and finally subtract capital expenditures. Both methods aim to arrive at the same crucial figure, providing flexibility based on the available financial statements. The key is to consistently apply the chosen method for accurate analysis. The presence of consistent positive free cash flow is a powerful indicator of a company's financial strength and flexibility. It signifies that a business is generating more than enough cash to run its operations and maintain its assets. This surplus cash provides a company with numerous strategic advantages. It can be used for significant debt reduction, strengthening the balance sheet, and reducing financial risk. Positive FCF also empowers companies to return value to shareholders through dividends or share buyback programs. Crucially, it fuels investment in growth and innovation, allowing for expansion, research and development, and staying competitive. Furthermore, a healthy FCF provides the financial flexibility for strategic acquisitions, enabling companies to expand their market share or diversify their offerings. In essence, positive FCF is the bedrock of long-term sustainable growth and shareholder value creation. While positive FCF is generally a good sign, negative free cash flow isn't always a red flag. In fact, for certain companies, particularly high-growth startups or those in rapidly expanding industries, negative FCF can be a natural and even necessary part of their development. These companies often invest heavily in research and development, new facilities, or aggressive market expansion, which results in significant capital expenditures that temporarily outweigh their operating cash flow. This is a strategic choice aimed at future profitability and market dominance. However, persistent negative FCF without a clear growth story or a path to positive cash generation is a serious concern. It suggests a business might be unsustainable, relying on external financing to stay afloat, which can lead to liquidity crises or increased debt. Context is key when interpreting negative FCF. For investors, free cash flow is an indispensable tool in making informed investment decisions. It forms the backbone of sophisticated valuation models, most notably the discounted cash flow, or DCF model. In a DCF analysis, future free cash flows are projected and then discounted back to their present value, providing an intrinsic value for the company's shares. This helps investors identify whether a stock is currently undervalued or overvalued. FCF also helps in identifying financially robust companies that can fund their growth internally, reducing reliance on debt or equity issuance. Moreover, by comparing FCF across peers within the same industry, investors can gain insights into which companies are more operationally efficient and better at converting sales into actual cash, offering a clearer competitive advantage than traditional earnings metrics. Businesses looking to enhance their financial health and investor appeal should actively implement strategies to improve their free cash flow. One primary approach is to increase revenue, not just through higher sales volume, but also by optimizing pricing strategies. Simultaneously, rigorous control over operating costs and a relentless focus on enhancing operational efficiency can significantly boost cash generated from operations. This includes streamlining supply chains, negotiating better terms with suppliers, and reducing waste. Effective working capital management is another crucial lever. Optimizing inventory levels, accelerating accounts receivable collection, and strategically managing accounts payable can free up substantial cash. Finally, prudent capital expenditure, Capex, is essential. While necessary for growth, ensuring that Capex is well planned, justified, and yields a strong return on investment prevents unnecessary cash outflow. By focusing on these areas, companies can build a robust FCF stream. In conclusion, free cash flow truly stands as the ultimate measure of a business's health, vitality, and ability to generate genuine wealth. It strips away accounting complexities to reveal the true cash-generating power of a company. For business leaders, it serves as a critical compass, guiding decisions towards operational efficiency, strategic investment, and sustainable growth. For investors, FCF is your North Star, illuminating which companies possess the financial strength to weather economic storms, pay consistent dividends, and drive long-term value creation. By understanding, analyzing, and prioritizing free cash flow, both businesses and investors can make smarter, more informed decisions, fostering resilience and unlocking true potential. Make FCF analysis a cornerstone of your financial toolkit. It's the key to navigating the complex landscape of sustainable business and maximizing investor value.